This is the Asia Trade. I'm Paul Allen in Sydney, where markets have just opened.
I'm Haidi Stroud-Watts. The top stories this hour. Asian stocks are set to climb following a rally on Wall Street as the Fed holds rates. Chair Powell signalling no drastic response to President Trump's trade war, despite some inflationary pressures.
Inflation has started to move up now, we think partly in response to tariffs, and there may be a delay in further progress over the course of this year.
The Philippine Central Bank chief also warning of uncertainty around trade and tariffs. We hear exclusively this hour from Eli Remolona.
Plus, AI in focus with Tencent to speed up spending following strong earnings growth. And we hear exclusively from a potential new rival, Chinese startup, Manycore Tech. Take a look at how US futures are shaping up at the moment as we sort of see Asia's first reaction to the Fed commentary in particular. Not so much controversial was the decision, of course, but the Fed Chair Jerome Powell saying there's no reason to change the current path of monetary policy, easing some of these ongoing concerns about recession risk, about the inflationary impact of Trump's trade war. We are expecting to see some upside being passed through to the session. S&P futures up by just about 0.3%. We are seeing Nasdaq 100 futures also up by 0.3% there, and a little bit of a bump when it comes to oil as well. These ongoing geopolitical concerns weighing. But Paul, really this kind of base case that any inflation bump from trade tariffs would, revive that phrase transitory.
Yeah, let's take a look at how we're tracking in Australia and New Zealand. Meanwhile, a bit of positivity on the NZX at the moment. And we mentioned New Zealand today because the country's out of recession. 0.7% growth for the fourth quarter. So that's that. The cash rate in New Zealand, 3.75%. There have been a series of aggressive cuts from the RBNZ over the past few months, with probably another 50 basis points likely to come in April and May. Not a great deal of change for the Kiwi dollar there on that news. 0.5817 at the moment. We are also open here in Australia. Always hard to get a read on things, of course, in the early going with the staggered open, but signs of some positivity there, better to the tune of 0.1%. We'll get unemployment numbers for Australia for the month of February out a little bit later as well, though we're not expecting to see any change there. Speaking of unchanged, Haidi, the Fed not doing anything, much as expected, but we did see a pretty decent rally in stocks, and interesting to try and parse the reasons for that, because depending on your perspective, that the dots were either hawkish or they were dovish. But we did hear from Jay Powell, and even though he was a bit equivocal, he had some reassuring words about the strength of the economy. Let's take a listen.
My colleagues and I remain squarely focused on achieving our dual mandate goals of maximum employment and stable prices for the benefit of the American people. The economy is strong overall and has made significant progress toward our goals over the past 2 years. Labor market conditions are solid, and inflation has moved closer to our 2% longer run goal.
And of course, core to this commentary, Paul, is really waiting to see what he says about the Trump trade war, the impact of tariffs, tariffs coming back into the US through retaliation. And he was, I thought, quite managed in terms of expectations, because at the end of the day, it must be really hard to try and model against these uncertainties. So let's take a listen to what Chair Powell had to say about trade and tariffs.
Going to be very difficult to have a precise assessment of how much of inflation is coming from tariffs and from other, and that's already the case. You may have seen that goods inflation moved up pretty significantly in the first 2 months of the year. Trying to track that back to actual tariff increases, given what was tariffed and what was not, very, very challenging. So some of it, the answer is clearly some of it.
Let's bring in for some analysis Sebnem Kalemli-Ozcan, who's a professor of economics at Brown University. So we've seen the revival of that phrase transitory when it comes to the impact of inflationary forces being driven by Trump's tariff policies. Do you think the markets are right to be as reassured? Because the crux of Chair Powell's reasoning seems to be that at this point we just really don't know.
Yes, I mean, there's a lot of uncertainty, and that's exactly what Jay Powell said, right? It is very hard to predict what will happen, and also it's hard to predict how much of the current inflation is due to tariffs. Why? Because I mean, tariffs themselves are uncertain. We don't know which of the tariffs are going, which are not going. Some announced that they were going to put, but they are not in effect right now. So I think the trade uncertainty overall, the uncertainty surrounding the tariffs is more damaging right now to the economy overall, both on the inflation side and on the growth slowing down side. But Fed is basically saying we are going to stick to our mandate and we are going to watch the data. And if the inflationary pressure increase due to tariffs in the future months, we are going to act accordingly.
I think you make a really key point there, is that regardless of the actual inflationary impact of tariffs and the impact on US growth, how damaging is it on sentiment, on confidence, both in terms of corporate confidence, but also consumer confidence with this ongoing volatility? And how hard is that to reverse, even though we know that President Trump, in a matter of hours, can actually reverse those policies and quite often has gone back and forth?
Exactly. And I think that is the real damage so far. And in fact, that is the biggest reason why we are now seeing or starting seeing or might see some sort of a slowdown, right? We kind of seen it in the sentiment, consumer sentiment, business sentiment, especially when you look at the small business sentiment that are engine to growth, that is really, really deteriorated. And we feel like the interpretation of that is consumers now going to delay consumption. Investment is going to be delayed, especially by small and medium-sized enterprises. That is going to be very, very damaging, because that is going to bring this slowdown, and that's going to make Fed's life in the future very difficult, especially if we combine that with some sort of higher prices coming from the cost side, because as you know, some of these tariffs, again, this didn't happen, but can happen, supposed to be put in the inputs to the production that we import from other countries. That means it's going to be higher production costs for companies, especially small, medium-sized enterprises, which then going to be reflected to consumers. But all these, not even happened yet maybe, but the uncertainty around that and may happen type of thinking is going to lead consumers and investors and small business owners delay consumption and investment.
Professor, it does sound like you're starting to talk about stagflation there. I mean, how great would you say this risk is? Not very high, but it is possible. It is definitely possible. I would put it at a low risk scenario, as Powell did for the recession. So I think the most obvious and quick thing is going to be on the inflation side, because some tariffs are already in effect and some are going to come. So clearly, prices are going to respond first, so we are going to see it on the inflation side. And then for stagflation, you also need some serious slowdown in the economy. You need basically a recession. The chances of that is still lower, but it is not zero. It is definitely not zero. I just wondered also if you could give us your interpretation of the dot plot. We did see some of those dots moving up a little bit. How do you read that?
I also read that as indication of uncertainty and deteriorating sentiment. We see the dots moving up. We also see a lot of scattered dots, right? I mean, it seems like there is a lot of uncertainty among the members because the outlook is uncertain. So that is totally reflected to the dots as it is reflected to consumer and business sentiment.
I wanted to get your views on the labour market and whether you're seeing kind of any skewing of the views on the labour market as a result of immigration and deportation policy.
So that is something also I think going to come later, because to have a big dent in the labor market, think like the negative labor supply shock we had during early days of COVID, the numbers should be very big, right? So in the early days of COVID, we had this huge unemployment, what the economists call negative labor supply shock, because it is coming both from closing down businesses, lockdowns, and also people, getting sick and all that. So here we don't have it that scale, even with the government being, under the Department of Government Efficiency, aimed to be having a small government. There are firings there, and also there is these deportations. Still, altogether, it is not at a scale that will affect the aggregate labor market in the economy. And that's also why I think Chairman Powell says the economy is still strong. But of course, I mean, if the extent of these things, become much larger deportation, much more firings from the government sector, then we might see some effect in the labor market too.
In the spirit of the times, I'd like to throw another wild card into the mix here. It is, of course, Jay Powell's final year of his term, and the next Fed chair will be a Trump nominee. How do you see Fed policy evolving in the post-Powell era?
I have no idea. I'm hoping the administration will do the right thing and will not create additional financial market volatility.
All right, Sebnem Kalemli-Ozcan, Professor of Economics at Brown University. Thanks for joining us and for rolling with the punches there. Just want to get you across an alert on the Bloomberg terminal. Hong Kong Monetary Authority, no huge surprise here, keeping its base rate unchanged at 4.75%. So no change to the policy rates in Hong Kong. Still to come on the Asia trade, we're going to continue our analysis of the Fed's decision to hold rates with Columbia Threadneedle, and UBS tells us how they recommend investors can take advantage of market volatility. Much more ahead. This is Bloomberg. In a call with President Trump, Ukrainian leader Volodymyr Zelenskiy has agreed to pause strikes on energy assets, echoing an agreement the US and Russia made earlier this week. Trump also pledged to help Ukraine strengthen its air defense systems. Bloomberg's Michael Heath joins us now. So, Michael, tentative steps towards a potential ceasefire, but I guess the question, particularly when Russia's history with such things are concerned, can it hold?
Yeah, it's an interesting one, Paul, and obviously it's better than we had in the White House, a week or two back. And it was an interesting formulation that when Zelensky mentioned it again, we talked about it yesterday, that Ukraine sort of saying we'll pause strikes on energy and infrastructure as opposed to Russia's energy infrastructure. So I'm just wondering whether he's giving himself a little bit of an opening there in case Russia then starts to attack, to keep going on its formulation of only holding off on energy infrastructure rather than bridges and these sorts of things. So we'll have to see how that goes. But I think just even President Trump suggesting that they would try to provide some Patriot missiles, some defence for the for civilian areas, it's a positive. Ukraine doesn't have many options here. It's got to try to stick close to the US and hopefully just hope for the best in many respects. They also talked about energy assets. There's this very large nuclear power plant that's in Russia's sector, and President Trump suggesting that perhaps US ownership would help protect that, which it probably would. In fact, Russia's going to be much more careful in attacking energy infrastructure that's US owned. So you look positive signs, but exactly as you say, I mean, what the Russian response was, whatever President Trump says, Putin gave him very little there. So we'll really just have to see how that unfolds.
Meanwhile, we're also seeing further escalation when it comes to the Middle East. This sort of limited at this point ground incursion into Gaza. Do we have any idea what the goal is and if it's sort of the start of a broader ground operation by Israel? Yeah,
it's hard to know, Heidi. I mean, when they first went in after the October 7 attacks in 2023, they also went in a limited, they'd have these smaller incursions, and then it was only later that they staged a full ground invasion. Now, Israel's defense minister did issue a warning to Hamas saying, this is your last chance to release the hostages and step down, which obviously Hamas hasn't done. But yeah, look, it's very unclear, and it's an interesting situation in Israel. Where just after those attacks by Hamas, the country was galvanised to respond. There's a lot less support now for going back in there. People have seen the hostages, they've seen the state that they're in, and many of them have spoken and said, look, the remaining hostages, they're clinging to life now. There's not a lot of time left for them. So the notion of going in and restarting this whole war is not quite as popular perhaps as it was before, and there's just sort of support that perhaps it's time to create do some sort of deal there. But this is a very right-wing government, and for Prime Minister Netanyahu, going back in has sort of shored up his strength there as well. He's had some nationalist lawmakers return to his coalition, so you'd suspect that they will go in further, but again, we just have to wait and see. But it seems to almost wax and wane. Russia and Ukraine sort of ease off and it ramps up again in the Middle East. It's an extraordinary situation.
Bloomberg editor Michael Heath there, and of course at the same time we're seeing the flow and impact of Trump's trade policy, where cheap Chinese goods are flooding emerging markets as the tariffs force manufacturers to find other countries to export to. That's led to something of a ripple effect from some markets in Asia. Indonesia, for example, has lost roughly 250,000 jobs in the textiles industry over the past 2 years. Bloomberg's Asia economics correspondent Katya Dmitrieva is with us, and Katya, this is really fascinating watching sort of the fabric of trade and some of these manufacturing centres really shift and change. What is kind of this idea of the new China shock, and where are we seeing that?
Yeah, it's China shock is really used to describe what happened in the 90s and early 2000s, right, with China's entry into the global trading system, and we had about 2.4 million jobs lost in the U.S., as well as broader economic impacts in mostly developed economies. But something interesting that we're seeing now is this China shock, if you want to call it, actually spreading to emerging markets. And even in places, you mentioned Indonesia, for example, a lot of Southeast Asian economies are kind of in the firing line for this. And these are countries rather that are pretty close to China, both politically and historically. Of course, geographically speaking, they're quite close, and they're bearing the brunt of it. And what that looks like on the ground is essentially very similar to what we saw in the U.S. Rust Belt, right? It's a lot of job losses. It's a lot of companies that are getting very upset, and industry groups talking to governments and basically asking for governments to make a difference, to make a change, whether it's tariffs or investigations or other actions.
In terms of other actions, I mean, Indonesia's President Subianto's threatening some fairly extreme measures in terms of sinking ships that are smuggling textiles. But what are governments doing to address this?
Yeah, that was a threat that was issued very recently just to try to get a handle on this issue and appease the population. There's a number of things that countries can do, but they're really in between a rock and a hard place, right? They are partners with China. China sends them FDI, foreign direct investment. It's part of the Belt and Road Initiative often. And so they want to maintain those good ties, but at the same time, they want to protect their industries and they want to protect people from these job losses. And so we're seeing things like a value-added tax on cheap imports that's targeting companies like Temu and a lot of these small packages that are coming in, and that's the way a lot of these goods are coming in. There's also tariffs on things like steel, which have been in place for a number of months. So there's kind of a number of ways that countries can target it, but, very limited.
We know that Beijing has for years now, even before the trade war, been trying to shift from being just an export powerhouse to strengthening domestic demand. But we also know that's taken on a new priority this year. Does that sort of change things at all?
Yeah, they're really targeted. Officials in China are really targeted at the consumer this year because they see that they cannot take this export-led growth and go forward and reach their 5% goal because, of course, we have Donald Trump's tariffs coming in very soon, reciprocal, and then China already has 20% tariffs slapped on its economy from earlier this month and the month before. And so the question is, how do you pivot to the consumer? That's still, honestly, a question that hasn't been answered for a lot of economists and investors. So if these programs are successful that China is launching, then perhaps they don't need to rely as much on exports and there won't be this kind of flood of goods intensifying globally. But for now, it doesn't look to be the case. I mean, China's trade deficit ended last year near a record, near $1 trillion. So it doesn't really give you a good outlook for the rest of the year in terms of that picture.
Bloomberg's Asia economics correspondent Katya Dmitrieva there. You can read more about the new China shock in today's Big Take. That's on the terminal, or you can find it also at Bloomberg.com. More ahead on the Asia trade. This is Bloomberg. The Philippine Central Bank Governor says he sees only a modest impact from the global tariff war. But Eli Remolona told us exclusively that the level of uncertainty this time around is much higher.
What assumptions are you making about what the Fed may be doing and the impact on the currency, the dollar here?
What we've seen so far is not so much what the Fed has been doing. What has the big factors have been geopolitical risk. When there's an event that makes people worry about geopolitics, then the dollar strengthens. It's a safe haven currency. Even now, it's a safe haven currency.
But what do you see the Fed doing? Some suggesting it will cut 3 times this year, 25 each time. Do you make that assumption as you look at your own monetary policy?
We just follow what the market says the Fed will be doing. And so the market is now saying 25 basis points in June. So in our models, we stick that into our model and see what happens.
There are also murmurings that perhaps the U.S. economy could be headed for a recession. Do you see that?
I don't see a recession, but I think a slowdown is very, very likely.
And of course, this is against a backdrop of tariffs imposed by the Trump administration. Might that have ripple effects on the Philippine economy?
Oh, absolutely, absolutely. The tariff war is likely to slow down growth for everybody and then raise inflation for everybody. By how much, we don't really know. But the bigger factor is the uncertainty itself. A change in tariffs, we can stick that into our models and then we can act on that basis. But the atmosphere of uncertainty is very different from this time. So that's harder to get a handle on.
So how badly might that hit the Philippine economy? Would it derail perhaps your 6% target, which you're confident of achieving?
The baseline calculations that we've made suggest a very modest hit on the Philippine economy. We'll be hit somewhat because we're part of a global economy.
Philippine Central Bank Governor Eli Remolona there speaking exclusively to Haslinda Amin. We do have just a story crossing the Bloomberg when it comes to confirming that SoftBank has sealed the $6.5 billion deal for the chip designer Ampere Computing. They're acquiring this in an all-cash transaction, really adding to SoftBank's ongoing push into AI infrastructure, giving it critical access to Ampere's advanced chip design, that team, as well as the technology too. Ampere will operate as a wholly owned subsidiary of SoftBank, keep its name and headquarters, and will be benefiting from access to resources as well as that larger customer base as well. That acquisition is expected to be announced later on Wednesday, but really broadening SoftBank's push into AI infrastructure. Some of the early backers for Ampere included the likes of Oracle, Carlyle Group, but this deal really just adds to the wave of chip companies looking to really capitalize on that AI spending boom. We had reported back in February that these advanced talks between SoftBank and Ampere had been ongoing. Oracle and Carlyle will be selling those stakes in the company as part of the deal, which is expected to close in the second half of 2025. This is a picture when it comes to US futures, as we see some of those sort of brave investors wading back in on the optimism perhaps that the US can avoid a recession.
Tencent has outlined plans to sharply raise spending on AI infrastructure after posting its fastest pace of revenue growth since 2023. Let's bring in our China correspondent Minmin Lo now in Hong Kong. So Minmin, a pretty decent set of numbers from Tencent. What were the key takeaways, particularly around that promised AI spend?
Yes, Paul, actually a very, very good quarter to end the year on for Tencent. It beat nearly every single metric estimates for its fourth quarter earnings. If you take a look at the table that we'll show you in a bit, its fourth quarter revenue came in at about 11% growth year on year compared to just 8% according to analyst estimates. And net income had nearly doubled. And again, it is because of the solid demand in gaming, especially with its new title, Delta Force. The company plans to turn some of these new titles into evergreen titles that could continue to generate steady cash flows in future. And of course, as you said, investors are most focused on AI and what the capex spending is going to be. And unlike its arch rival Alibaba, which has announced this all-in approach to AI, announcing a $50 billion spending over the next 3 years. But Tencent is a little bit more modest in its approach, looking at just the low teens percentage of its revenue in AI spending on infrastructure. And it's still going to focus on leveraging AI internally in things like its mini videos, its games and advertising revenue. And actually, some analysts are saying that Tencent is best placed. Our Bloomberg intelligence analyst Robert Lee actually said Tencent is best placed to generate the most immediate cash returns on some of these AI applications, unlike Alibaba, which is focusing on more sort of longer term and less certain prospect of artificial general intelligence. And Goldman Sachs also said that Tencent usually historically has been able to catch up at a late stage and narrow that market gap and really sometimes even surpass some of the first movers when it comes to AI.
You know, another stock that has surged, what, about 30% year to date is Pinduoduo. What are we expecting with the numbers and what's the kind of risk of margin disappointment?
Yeah, so a little bit of a mixed outlook here because Pinduoduo's revenue for the last quarter expected to grow about 30%. That's the analyst consensus. But because of the geopolitical uncertainties and Trump's trade policy, the potential revoking of that de minimis rule that has led to potential shipment delays as well as custom clearance issues, Pinduoduo may have to raise subsidies for some of its merchants to convince them to stay on their platform and to entice new customers overseas to transact on their platform. So that could eat into margins. And our Bloomberg intelligence analyst is saying that there is a risk of Pinduoduo actually undershooting that analyst estimate of a 30% rise in revenue and overshooting when it comes to that margin disappointment of 1.9% year on year. And you look at what options traders are pricing in, they're looking at about an 8.6% move in the share prices after earnings today.
Bloomberg's China correspondent Min Lo there. One emerging player in the Chinese AI space says it's looking to grow its global presence even as Washington tries to limit the country's access to high-tech semiconductors. Manycore Tech co-founder Victor Huang told us exclusively why he still sees great international potential.
I think just for the future, currently I didn't see any risk. It's pretty easy to buy the GPU what we need, and we also rent servers globally. So our business is not only in China. So right now we didn't face any trouble with GPU.
The sort of geopolitical tensions and you know the risks that the US further restricts China's access to advanced technology isn't something that has such a big impact on your business today.
Right now, we didn't face any such trouble because we embrace the open source ecosystem. The open source ecosystem is open to the whole world. We also contribute our efforts to the open source ecosystem. We in the GTC, we released our new open source software called Spatial ML for spatial recognition.
We know that AI generally in China, it's a very competitive landscape. How important is it for you to offer good pricing, essentially, and cheaper pricing than competitors to your customers?
We want to get as much users as possible. That is our strategy. We don't want to just earn too much money from every customer, but we want all the customer will affordable to our product. That is very important for our goal. So that is our the day one when we start up our company. We are going to optimize our rendering system to become cheaper and faster, then make it available for all the user and customers.
That's Manycore Tech Chairman Victor Huang speaking there with Bloomberg's Annabelle Jewellers. We have more ahead on the Asia trade. This is Bloomberg.
Think if you're in corporate America and you hear that, what do? You stop spending and you hold all the capital you can. This is a very dovish Fed.
I think this was much more hawkish, and the Fed not quite going to one rate cut, but the number of people who are expecting one rate or less cut this year going up. That gives you that sense of the dispersion of risk and the challenge of corralling the cats in a very uncertain environment.
There's kind of clear elements of both of these here. I think the market's view is it's not as hawkish as was anticipated. I think there was a fear of a median of one rate cut for today, and so far at least that fear was alleviated.
The market is rallying today because this was not as hawkish as it could have been. I think the risk coming into this was maybe we just saw one cut in 2025. We kept the two, but going forward, I think we should be baking in some widening credit spreads, and we would view that as an opportunity.
Business leaders and economists talking to Bloomberg about the Fed's decision to hold rates while forecasting slower growth and higher inflation. Let's get to our next guest now. Ed Al-Hussainy is a global rate strategist at Columbia Threadneedle. Ed, thanks so much for joining us there. As we heard, a diversity of views on the Fed decision today, but look, the market went up, pretty healthy gain on the S&P. What did markets find so reassuring about a message just so laden with the theme of uncertainty?
Yeah, it's a good point. I mean, if you look at the reaction this afternoon, the best interpretation is probably one around the fact that the Fed managed to increase its inflation forecast and yet leave the rate forecast unchanged. You know, that's an environment that in which the Fed is essentially on the sidelines. And as long as the Fed doesn't indicate that it has to react to higher inflation, that's a fantastic environment for risk.
And how long can the Fed remain on the sidelines, though? Do you have any concerns about recession risk, questions around growth or inflation making a comeback?
Yeah, and look, I think the two key issues the Fed is grappling with at the moment is, one, to what extent are inflation expectations starting to move higher? We don't see the impact of tariff, fiscal, immigration policies in realized inflation yet. But inflation expectations data is starting to make a little bit of a move. And what the Fed told us today is they're not really concerned about it at that stage. And then on the other side, to what extent is the economy weakening? Same thing, the soft data, consumer confidence data, business confidence data appears to be softening. But we've had these periods before. We had this at the beginning of 2023. Once again, the Fed is telling us they're not quite as concerned as they were in previous episodes. And so the Fed is on the sidelines. I'm not very concerned at this stage. I think the economy is coming into 2025 with considerable strengths. We're going to peel those strengths away in the course of the year, but I don't think there's really reason to be all that alarmed at this stage.
There were some tweaks around the language that might suggest sort of heightened stagflation risk, right? What sort of likelihood do you assign to that scenario? And is that something that's going to be, you know, stickier rather than transitory if it's more of a mindset that we see corporates and households starting to fall into?
Yeah, look, the unfortunate and unpleasant truth is no one knows. I'm definitely in that category as well. We're grasping a little bit in the dark. Here's what we do know. The pattern of disinflation that started, 2.5 years ago is very much still in play. I think that's one of the reasons why the Fed is comfortable allowing some of the data to play through. It's comfortable seeing some of the inflation expectations data move around and maybe move a little bit to the upside. There's a lot of room for the Fed to see this data play through and remain on the sidelines. The odds that we develop a stagflationary environment in which inflation dominates the growth story, I think those odds are still quite low. If anything, there's going to be room to be concerned about growth later this year. Again, at this stage, I think things are still fine. But later this year, if growth starts to slow and the labor market slows alongside that, it will be very difficult to sustain inflation. So I'm more worried about growth and less about inflation at this stage.
Is the stagflation risk why we're seeing US Treasuries rally less than perhaps you'd expect amid rising recession risk?
Look, I think Treasuries have done fine. The way I would frame it is growth at the end of last year, expectations for growth were really nailed to the ceiling. They were extraordinarily, I think, robust. We saw that in terms of risk assets rallying. We saw that in the form of a stronger dollar into the end of the year. And of course, interest rates moving higher. And so far, 3 months into 2025, we've partially undone that. The growth outlook is not as robust. The policies coming out of DC are not as supportive for growth. Obviously, the word uncertainty is dominating the conversation. And so there's a broader range of outcomes on the table for us. And Treasuries have rallied to reflect that. But again, we're not yet in a territory where Treasuries are reflecting recessionary risks. That happens when you wake up and you see the 10-year yield around 3.5%. I think we still have a way to go from that.
Ed, we also had another major central bank decision which has been somewhat put in the shade by the Fed. That was, of course, the Bank of Japan, also staying on hold, but also referencing considerable uncertainty around US trade policy. Do you have any forecasts to offer for Japan's economy and when we might see the next move on rates there?
Yeah, I mean, Japan has been a remarkable story in the sense that it's been disconnected from the weakness in growth, the weakness in inflation, or the disinflationary story in Europe and the U.S. over the course of the past year or so. Japan has room to raise rates. That is definitely not true for the other major developed market central banks. I expect them to hike 2 to 3 times this year. They definitely have the room to do that. Monetary policy in Japan, by and large, remains accommodative. And they are in an environment where they're seeing inflation finally start to grind higher. They're seeing a wage growth story that's very supportive of inflation. And those dynamics just don't exist in the rest of the developed world at the moment. So it remains an outlier. I think as long as U.S. trade policy doesn't bite, I think it's reasonable to expect that to have a little bit of a downside drag on growth. But as long as that doesn't bite too hard, the Bank of Japan should have room to hike another 2 to 3 times this year.
Well, we have seen JGB yields rising pretty steeply as well. Governor Ueda signaled he's not too concerned about that at the moment, but can you see a scenario where yield curve control becomes a conversation in Japan again?
Not unless there's significant downside risk to growth, which brings forward additional fiscal stimulus and makes those rates really inappropriate for the state of the economy. For the current state of the economy, rising rates, a steeper yield curve is very consistent with the domestic data. And that's, again, in sharp contrast to what's going on here in the U.S. and in Europe, where the growth story is weaker, the wage growth story is weaker. And that's reflected in those currencies. The yen and JGBs, in my mind, still have room to outperform. If at some point the trade war escalates to the point that we see global recession risks rise, I don't think the Bank of Japan is going to have to do that much. I think JGB yields will come down organically as we see those yields come down across the developed market world.
All right, Ed Al-Hussainy, global rate strategist at Columbia Threadneedle. Thanks so much for your insights today. Some of the top political headlines that we're tracking. Turkish authorities have detained President Erdogan's top political rival on corruption charges. The Istanbul mayor was arrested on Wednesday, triggering a sell-off in stocks and the lira. as protesters took to the street to oppose his detention. Imamoglu posted on social media saying the will of the people cannot be silenced through intimidation. Taiwan has identified 2027 as the potential year for a Chinese invasion in its annual military drills. The Defence Ministry mentioned the date for the first time in documents briefing lawmakers on upcoming drills, which will simulate an attack by the Chinese military. Beijing held military drills around Taiwan earlier this week. The Ontario Teachers' Pension Plan is to shut down its Hong Kong office in what sources say is a bid to reduce its China exposure amid rising geopolitical tensions. The fund managed about $178 billion as of mid-2024. In a statement, it says the Hong Kong office will be wound down over the coming 18 months without giving a specific reason. You can watch us live. You can see our past interviews on our interactive TV function, TV Go. There you can also dive into any of the securities or Bloomberg functions that we talk about, and you can become part of the conversation by sending us instant messages during our shows. This is for Bloomberg subscribers only. You can check it out at TV Go. This is Bloomberg.
Let's get you the latest from the corporate front. And the EU has issued twin rebukes to Google and Apple to comply with its big tech rules or risk hefty fines. Google was warned for allegedly breaching the bloc's Digital Markets Act by favouring in-house services and its own Play Store. Meanwhile, Apple was told to loosen controls over its iPhone operating system. Any future EU penalties could escalate tensions with President Trump. Ben & Jerry's is accusing its parent company Unilever of firing CEO David Stever because of disputes about the brand's social stance. In a legal complaint filed in New York, the ice cream giant alleges Stever was dismissed after he failed to stop the brand from speaking out on political issues. That dispute is part of a larger clash over how Ben & Jerry's communicates its social mission. Aman Group, which builds and operates some of the world's most expensive hotels, is planning to raise up to $2 billion to fuel its global expansion plans. The company says the funding will help it make headway on 23 hotel projects currently under development. The firm is also focused on expanding Aman residences around the world. Well, Bloomberg has learned that Elon Musk's social network X has raised close to $1 billion in new equity from investors, valuing the company at roughly $32 billion. Our Bloomberg reporter Katie Roof helped break this story and joins us now with the details. And Katie, I am curious, obviously X, since Elon Musk took over, has had a pretty tumultuous ride, a lot of pullback when it comes to advertising. So who is investing at this point, and I guess why?
Sure. So there's a lot going on here, you know, and technically it is the same valuation about that it was acquired at. So this is the first financial transaction that the company has had since being taken private in 2022 for $44 billion. But yeah, it's a vote of confidence from investors who clearly are not concerned that at one point there were fleeing advertisers. Certainly, you know, some of that has come back from what we understand. Some of the advertising is back, and then they have other revenue streams like subscriptions. But in general, you know, a lot of these private investors are just betting on a long-term vision here. They're betting on Elon Musk. We've seen the value of especially his private companies go up since, you know, Trump was elected, and his ties to Trump, some feel will be lucrative for his various portfolio companies, which, you know, include SpaceX and XAI. Another factor here is X is actually a significant shareholder in XAI, the AI-related platform with Elon Musk. And so when XAI goes up in value, the share of X's stake in XAI also goes up in value. And so indirectly, people are investing in XAI through X as well.
Katie, as Haidi mentioned, there is evidence that some marketers and advertisers are starting to return to X. Is that because they see a tremendous opportunity here, or is something else going on?
You know, it's hard to say. I'm sure it's a case-by-case basis with some advertisers. You know, certainly there's still a lot of active users on the platform. But, I think that when you have private companies here, it's a little bit different than public market investing. And so people can take a long-term view. They don't have to value it quarter by quarter or deal with daily fluctuations with stock movements. And so, investors, sometimes institutional private investors are investing on a 10-year time horizon. So they may be optimistic about, what Elon has touted as his vision for the platform. It may not even be about day to day. And to be clear here, there's two numbers, and it's because there's the equity value and then there's the broader enterprise value that includes debt. The company has taken on a lot of debt, and then they also have these private equity investors.
How much does Elon Musk's clout at the moment, both within the Trump administration and also some of the reporting that we've done on threatened legal action against marketers and advertisers, play into this dynamic?
Yeah, and so I think that originally, even with Tesla, there was a bump after Trump took office. I mean, that has changed course. But with the private companies, some are saying that is explicitly a reason that they're investing. I mean, it's a case-by-case thing. It depends on the investor. But yes, for some people, they feel that Elon's ties to Trump means, he won't face the same level of regulatory scrutiny, or that he'll be able to, have the president's ear on different initiatives that could be lucrative for his businesses. A lot of this is obviously speculation, but that is the perception and why some people are investing in his companies.
All right, Bloomberg reporter Katie Roof on the latest with X there. Let's take a look at how we're doing on those markets that are open at the moment. Bit of a risk on tone after that Fed decision. New Zealand better by 0.25%, and we mentioned New Zealand because the country is out of recession, reporting 0.7% growth in the last quarter. Recovery in manufacturing and house prices, appear to have stopped falling as well. The Finance Minister, Nicola Willis, saying New Zealanders can look forward to better days. The ASX also in positive territory at the moment, Heidi.
Yeah, take a look at the reaction when it comes to the FX side of things, right? We are kind of watching for dollar-yen action in particular. Could be quite an interesting session with Japan on a public holiday. We're also kind of seeing FX traders broadly making their way through the carnage of that meltdown in the Turkish lira there as well. We're seeing a bit of upside there trading in the Aussie dollar and in the Kiwi. Market open in Seoul is next. This is the Asia trade. We're counting down to Asia's major market open in Seoul, and of course a bit of a truncated session given that we do have Japan not really able to react to the day after the Fed are going on holidays today, but certainly a pretty strong lead. We had kind of some of those that were staying on the sidelines waiting back in, talking down the idea of recession risk, and maybe that's alleviated some of the anxiety for US investors.
Yeah, certainly the theme of uncertainty was very, very strong in Jay Powell's remarks, but this idea of a steady hand, no great changes, nothing really here to scare the horses, remaining data dependent. That was enough to provide the reassurance that the market seemed to be looking for.
Yeah, regardless of still a lot of the uncertainties ahead when it comes to trade and tariffs. We saw the best Fed day for US markets since, July, actually. To take a look at the follow-through when it comes to Asia, like I said, just the Kospi coming online at the moment with Tokyo on holidays today. So watching the impact when it comes to the yen in particular. But the Kospi looking like will extend gains into a fourth day. Of course, the previous session was really driven by strength in just about one stock, Samsung in particular. We have, of course, Morgan Stanley raising its price target on Samsung, looking like an M&A will be achieved this year as well. That stock has been rallying pretty strongly so far this year, but the Kosdaq at the moment up by just about 0.6%. We've also seen Hynix as one of the gainers this week as well. We've seen local and foreign funds adding Kospi equities on a net basis. Some selling from retail investors, though. Watching the won at the moment as we continue to see kind of that relief when it comes to US assets, given some pretty measured comments from Fed Chair Powell. We're also watching on the political front, given how much uncertainty This element is added for the investor outlook for Korea. We're watching to see whether we potentially get from the Constitutional Court the ruling on President Yoon's impeachment trial, as we could potentially get that before the end of the week, but potentially that gets pushed out to next week as well, Paul.
Yeah, well, in the wake of the Fed decision, we did see a little bit of softness for the US dollar, and that's translating into a little bit of strength for the Aussie and some of the other G10 currencies as well. Seeing some positivity on the local market, also the ASX better by 0.8% at the moment, with pretty much every sector in the green. Information technology stocks leading the way there. Now, as Haidi mentioned, no trading in the US debt today because Japan is, of course, closed, but we did see yields for both the 2 and the 10 years pulling back just a little bit in the wake of that Fed decision, and then we see bond futures just ever so slightly modestly higher at the moment. Now, of course, Jay Powell was the man of the hour. He did frequently cite the uncertainty around the tariff environment. Let's have a listen to what he had to say.
There's always an unconditional possibility of a recession. The economy is strong overall and has made significant progress toward our goals over the past 2 years. When it comes to changing something in this highly uncertain environment, I think there is a level of inertia where you just say, maybe I'll stay where I am. It can be the case that it's appropriate sometimes to look through inflation if it's going to go away quickly without action by us. Going to be very difficult to have a precise assessment of how much of inflation is coming from tariffs. Surveys of households and businesses point to heightened uncertainty about the economic outlook. Looking ahead, the new administration is in the process of implementing significant policy changes in 4 distinct areas. Uncertainty around the changes and their effects on the economic outlook is high.
Let's get more on the market reaction. Bloomberg MLA strategist Mike Cranfield joins us now for more. And Mike, were you surprised at all when it comes to the relief rally that we had, the sort of broad upside being seen, despite still a lot of uncertainty and unknown being highlighted by Chair Powell?
I think investors are probably focused on the fact that the dot plots are still predicting 2 interest rate cuts this year from the Federal Reserve, which is pretty much a relief for people who are thinking that maybe the Fed would be a little bit more hawkish than that. But actually, for now, it sounds as though they're still willing to go with the same idea that they will be able to cut rates later in the year. And you just heard Jerome Powell there talk about is a kind of a willingness to look through some of the potentially inflationary impacts from some of the new policies coming out of the White House. Now, this is the bit that is where the market is probably going to start to get a little bit interesting. Bond traders are probably not going to be willing to look through in the same way that Jerome Powell is. This is where the bond vigilantes may well come back into play. We saw a little bit of steepening in the US curve last night, and there is certainly room for quite a bit more of that as people start to think that the Fed maybe is taking a little bit too much of a relaxed approach to tariffs and the risk of upside inflation, and of course the changes to the employment situation in the US as well. That could well play out in a much steeper US yield curve. People lose faith in the long end of the Treasury curve, and you start to see that impact other markets. It'll probably be supportive for the US dollar, and eventually it will start to become negative for the equity market as well. So we've seen a bit of a knee-jerk reaction. That's probably the fact that people are hoping that rate cuts will still come through. But the unintended consequences in terms of inflation and what that means for the US fiscal situation are still to play out. So I suspect that what you see, first of all, is not going to be the final picture here. Equities may have liked it, first of all. They won't like the fact if the bond market vigilantes start to push the curve steeper, that'll end up being a negative for stocks as well.
In the past few weeks, we've seen something of a rotation out of US stocks into China in particular. Post this decision, is that trade likely to change?
There's nothing at the moment that suggests that the Chinese tech narrative has changed at all. It still seems very positive. This week has been a great week, if you believe in the Chinese story. BYD talking about a charger for their cars that can be as fast as the same for petrol-based cars. That's really a game changer in that space. You've also got more people coming on board with their own version of AI products which replicate what we've seen with DeepSeek as well. So again, that's positive across the board for the Chinese tech picture as well. Got decent picture from Tencent last night that will restore confidence as well. So all the things are moving into place here, and importantly as well, the Chinese government is still endorsing the sector as well. They're not doing anything to prevent changes in that way. So yes, the Chinese story seems to have legs of its own. It may be a little overheated in the short term, but there's nothing that happened from the Fed side of the story that will stop people believing that there's more to come. Providing the Chinese tech companies continue to show good earnings and they keep on dropping stories that they're producing more with the AI factor as well, that could keep this running for quite a long time. And we're still coming from a pretty low base here. The chance for catch-up compared to the Magnificent Seven in the US, there's still a long way to go. China's been underperforming for a couple of years. This story could well play out for months and months.
All right, Bloomberg MLive strategist Mark Cranfield there. Now on a call with President Trump, Ukrainian leader Volodymyr Zelenskiy has agreed to pause strikes on energy assets, echoing an agreement the US and Russia made earlier this week. Trump also pledged to help Ukraine strengthen its air defense systems. Bloomberg's Michael Heath joins us now. So, Michael, it's always interesting looking at the readout of these calls after they happen, and the US side described this as fantastic. Has this relationship between Ukraine and the US been repaired so soon after that White House bust-up?
Yeah, it's an interesting one, Paul. I don't think either side really wanted it to be. I mean, certainly Ukraine didn't want that, but even on the US side, I don't think they wanted, quite the blow-up that occurred a couple of weeks earlier, because they are trying to negotiate a truce and then peace, and they need to have buy-in from both sides. And the US already has a lot of influence over Ukraine, so whether it needed to go so far, I think, is questionable. But yes, the American officials described that as a fantastic call, and President Zelensky said that President Trump briefed him on his call with Russia's leader Putin, and yeah, as you mentioned, Zelensky has agreed to that Ukraine won't target Russian energy assets, and it had been running a pretty successful campaign there, which is not only frustrating for Russia, but it hurts its revenue. Oil and gas and hydrocarbons are obviously the lifeblood of Russia. So yeah, that's it's going to be interesting to see how it plays out, and especially the whole idea of the US providing some Patriot missiles to help defend Ukrainian civilian infrastructure. So yeah, it was obviously a complete reversal from a couple of weeks ago. But yeah, it's really whether Russia buys in. I think now there's no question that Ukraine is sort of prepared to toe the US line, and I think Ukraine sort of it's keeping its powder dry. It wants to wait until there's something really serious that it needs to object to. In the meantime, it'll stick close to the US.
While the focus has been on this, the focus has obviously been on the tit-for-tat trade situation as well. The unravelling of the Gaza ceasefire has sort of an element of inevitability to it.
Yeah, it does, Heidi. I mean, we had this sort of basically the truce there. The initial phase one there ended in early March, and it had been prolonged, and obviously we're in Ramadan as well, and so there was some expectation that maybe that quiet would keep going, but it had been, tensions had sort of been ratcheting up, while I guess the world was focused on trade and on Ukraine and that sort of thing. Israel was really, really unhappy with a lot of the propaganda displays by Hamas as these hostages were being released, and there was a situation where one group of hostages were just looked in appalling conditions, and so there was a lot of frustration. Israel's government, Prime Minister Netanyahu, was also under pressure from the really hard right elements in his government, some of whom even walked out on it to resume attacks on Hamas in Gaza. One of Israel's goals was to remove Hamas from power, which is obviously very, very difficult to do. But the Israelis are saying that this is, the resumption of the attacks is basically that they want to get their hostages out, and it's sort of a bit of a contradiction in a way, because the only way that hostages have been released is through peace talks here and truces. It's never been the case, except very, very occasionally and luckily where they found the odd person that they've managed to secure hostages there, and removing Hamas again. I mean, they're going to have to do some really severe damage to get that happening.
What's the scenario when it comes to Netanyahu's grip on power at the moment? How much domestic support there is?
Well, yeah, it's a really interesting one. I mean, there's not. When the Hamas attack first happened, and Israel was in shock, it really, really galvanised the country. And even though it had been quite divided, I mean, people who are hostile to Netanyahu were very hostile, and it's pretty polarised. And those who support him, obviously, the majority as well. So there's a real polarisation there, but Israel came together and obviously they fought very, very well and very successfully in this campaign, whether it's against in Gaza or against Hezbollah in Lebanon as well. But yeah, look, there's not the same level of support, it seems, for going back into Gaza. People saw the state of the hostages. They've heard since from the hostages, freed hostages, that those who are still remaining in Gaza are really in bad shape, and they'd like to see the conflict brought to an end and people released, basically. So yeah, there's a bit of division returning there.
Bloomberg editor Michael Heath there. More ahead on the Asia trade. This is Bloomberg. Tencent has outlined plans to sharply raise spending on AI infrastructure after posting its fastest pace of revenue growth since 2023. Our China correspondent Min Lo joins us now from Hong Kong. So what did we make of these earnings and the path forward?
Hey Heidi, yes, it's an excellent quarter for Tencent. The company is announcing 80 billion Hong Kong dollars in shares buyback and also raising its annual dividend payout by 32%. And that's after a strong beat across most of these metrics that you see on the screen now. Revenue coming in at about 11% growth on year compared to estimates of 8%. Net income nearly doubling. A big part of that is driven by very strong demand for its gaming segment. But of course, all the attention now is on AI and how much the company will spend on capex. And so far, the Tencent management is saying they will dedicate about the low teens % of their annual revenue this year on AI infrastructure. That's estimated to be about $10 billion, so slightly less than what Alibaba has planned to spend, which is $50 billion over the next 3 years. But Tencent still planning to leverage these AI applications internally in its mini videos, its e-commerce, and its WeChat super app. That app is really best placed to potentially become the next AI super app or AI agent. But our in-house analyst Robert Lee has some warning about profits this year, saying that earnings could start to normalize in 2025, and there are risks when it comes to the limited supply of NVIDIA chips and potential tightening of the news when it comes to export controls. That could risk constraining Tencent's growth, especially after the management had confirmed at the earnings call yesterday that they had to ramp up last-minute purchases of GPUs after the company's cloud computing growth had been temporarily constrained after computing resources had been diverted to meet the company's internal demand.
Min, more earnings on the way today. Pinduoduo for the fourth quarter. What are we expecting there?
So the consensus is now that we can see a revenue growth of about 30% in the last quarter, but there are a lot of headwinds this year because of Trump's trade policies, the potential revoking of that de minimis rule and what that would mean for customs clearance and for shipping times. So the company may have to spend more on subsidies to get merchants to stay on the platform and to entice overseas new buyers to transact on their platform. And given that Pinduoduo's Temu app derive about a third of their gross merchandise value from the US, that could risk Pinduoduo actually undershooting analyst estimates when it comes to revenue of 30% growth on the last quarter, and also perhaps disappointing when it comes to the margins there that could fall, according to analyst consensus right now, about 1.9% year on year. But our in-house Bloomberg analyst believes it could be even higher than that. So options traders now estimating or pricing in rather about 8.6% move on that stock price after earnings.
All right, Bloomberg's China correspondent Min Lo there. Well, let's bring in Sundeep Gantori now. He's CIO Equity Strategist at UBS Global Wealth Management. Sundeep, thanks so much for joining us. We've seen some pretty decent numbers coming out of some of these Chinese tech names at the moment, but the stocks have rallied accordingly. Do you chase this rally in China tech at the moment?
Yep, thanks for having me. So if I take a step back and look at, as you pointed out, we had a very strong performance for China tech versus US tech year to date. And the way we see the results, you're right, pretty impressive numbers across the board. Ad revenues, e-commerce monetization, even gaming revenues have surprised. But when I look at the latest set of results, actually numbers, particularly as far as capex for 2025, now they're starting to come more in line with the recently revised estimates. So that's the reason we think now the risk reward for China Internet or China Tech versus, for example, the US Internet now looks slightly less favorable. So recently we downgraded actually China Tech to more neutral, as we believe the risk reward now starts to look much better in US Tech after the recent correction. Doesn't mean that there is no upside, but we think that actually US Tech now offers much better upside after the recent correction. Whereas with China Tech, we see still decent, low teen and or perhaps 10% upside from here for the rest of the year.
Well, when we heard from Tencent, we also heard about plans to massively increase spending on AI. But when you hear things like that, does it raise the same sorts of questions for you that we've been hearing about US tech as well? It's like, it's great to spend that money, but when do you actually see a return on your AI spending investment in terms of revenue and productivity gains?
Right. So I think that's going to be a debate, and we have been highlighting how 2026 or even 2027 is when we started to see actually improving monetization there. But having said that, when we actually look at the recent financials of some companies and focusing on the more employee productivity numbers, and we found that in some cases, particularly those with early adopters of AI, when we measure total revenues per employee, in some cases we have seen a significant jump in some of the internet companies in the US and some of the fintech startups also, where employee productivity for these companies who have invested in AI is actually up around 25% per annum. So I think there is now a case emerging, at least those who are able to integrate AI in AI agents or perhaps also in content moderation, starting to see the results. But for the overall industry, I would say still it's going to be 2026 or 2027 where you start to see the big return. And this is similar to how it played out in cloud. It took almost 8 to 10 years for cloud actually monetization to improve. Cloud started in 2006, and only in 2015 or later we started to see profits, and probably that's how the market started to reward those companies after that.
We continue to see the gains and the enthusiasm being driven by DeepSeek, Manus more recently as well. But do you see this as being disruptive in terms of curbing investment in AI investment, or to the contrary for companies like NVIDIA?
Right. So, we think in a bipolar world where there is a tech race between US and China, I think export controls are something that we have to live with. And if you see the way Chinese tech companies have found a way, you mentioned DeepSeek as an example, on how to optimize and take advantage of some of the homegrown algorithms and technologies. So I believe, and I think earlier you also alluded to how growth in some of these companies would be limited partly because of constrained supply. So I think this is something we should actually accept going forward. But at the same time, I think at the end of the day, if companies are able to, introduce low-cost algorithms, low-cost models, and also focus more on the consumer side of things, because the way we look at AI, in the US, it's going to be dominated more B2B enterprise AI, whereas in China, I think AI will be more popular in consumer, and perhaps you don't need such expensive GPUs or massive investments. So I think we have been highlighting why there is actually growth, and the market is big enough for both to grow, US on the enterprise side and China to focus more on the consumer AI.
What is your strategy when it comes to uncovering more opportunities in the China space?
So I think the way we look at China tech and opportunities in AI today, I think we can definitely look at the playbook in the US, where if you see the first 12 to 18 months, it's always about companies with deep pockets, first-mover advantage that have actually done very well. So similarly in China, we believe those companies with first-mover advantage in large language models, also deep pockets, the fact that these companies are able to invest aggressively in capex, which means they will definitely have, at least priority in terms of access to GPUs or whatever constrained GPUs they have, and also the ability to build LLMs. So we think something similar would play out. On top of that, we also believe the homegrown semi-supply chain companies would also benefit because of the export controls. I guess there will be alternatives whether it comes to memory, whether it comes to the other supply chain. We think that clearly there are more opportunities that are available for investors within China as part of the semi-supply chain. But at this stage, it seems like the playbook, how it worked in the US in terms of the big platforms that had deep pockets, I think that's also something that would play out in China. At the same time, we also think we would avoid, similar to what we did in the US, avoid some companies which may not have strong, advantage in terms of LLMs, because at the end of the day, without LLMs, perhaps it's going to be quite tough for some of these smaller platform companies to monetize AI.
Sundeep, really great to have you with us. Sundeep Gantori, CIO Equity Strategist at UBS Global Wealth Management. More ahead on the Age of Trade. This is Bloomberg.
Some of the top political stories that we're tracking. Turkish authorities have detained President Erdogan's top political rival Ekrem İmamoğlu on corruption charges. The Istanbul mayor was arrested on Wednesday, triggering a sell-off in stocks and the lira as protesters took to the street to oppose his detention. İmamoğlu posted on social media saying the will of the people cannot be silenced through intimidation. Taiwan has identified 2027 as the potential year for a Chinese invasion in its annual military drills. The Defense Ministry mentioned the date for the first time in documents briefing lawmakers on the upcoming drills, which will simulate an attack by the Chinese military. Beijing held military drills around Taiwan earlier this week. The Ontario Teachers' Pension Plan is to shut down its Hong Kong office in what sources say is a bid to reduce its China exposure amid rising geopolitical tensions. The fund managed about $178 billion as of mid-2024. In a statement, it says the Hong Kong office will be wound down over the coming 18 months without giving a specific reason. Haidi.
Let's take a look at how European stocks are faring as we continue to see that reaction to the Fed, some of that relief rally potentially passing through to the European session as well. Stoxx 50 futures and German DAX futures both up by about 0.2% there. A little bit of upside there in the euro. We have seen stocks just trickling a little bit higher even going into that Fed decision, so we could see a fifth straight day of gains for European stocks. Investors also weighing the progress that's being made incrementally on the potential deal between Russia and Ukraine and brokered by the US, of course. We've seen that outperformance in energy and retail stocks with the upside in oil, some of the lag coming from chemicals and telecoms as well. We're also seeing perhaps a little bit of a pullback in the biggest European defence names, and those stocks have been some of the biggest drivers of this European rally, of course. But looking like we're set for that fifth straight session of gains in Europe. More ahead on the Asia Trade. This is Bloomberg. Getting a labour market data crossing the Bloomberg for Australia. The employment change for February, a contraction actually of 52,800 jobs removed from the economy. The expectation was for a gain of 30,000 jobs, building on the back of the 44,000 added in January. The unemployment rate staying unchanged at 4.1%. That was fully expected. Full-time jobs, we see a loss of over 35,000 roles. Part-time employment change for February, seeing a loss of 17,000. The participation rate ticking up slightly to 66, falling slightly to 66.8 from 67.3. Expectations were for the participation rate to stay unchanged. So certainly Bloomberg Economics had been expecting moderate job growth, a slowing, but perhaps a steeper slowing is what we're seeing now, despite no increase in the unemployment rate there. We do know that the monthly unemployment data can be pretty wild, pretty volatile, and that is the risk that we see, the real surprise to the downside, given, Paul, that we have seen quite significantly strong job growth over the past few months.
Yeah, we're seeing the Aussie dollar losing a little bit of ground off the back of that downside surprise, 63.32 against the greenback at the moment. Also saw the ASX ticking up just a little, although it's given up some of those gains, but the market's still better by 0.8%, following on from some of the gains that we saw in the US after the Fed decision. So that still seems to be the more powerful of the catalysts here. We do have an RBA meeting towards the end of this month, although we're not expecting to see any change in policy settings. Elsewhere, we're seeing the Kospi gaining by 0.25%. Similar scenes in New Zealand. New Zealand, by the way, just exited recession today, 0.7% growth for the fourth quarter. Japan isn't on that board because Japan's having a holiday, Heidi.
Well, cheap Chinese goods are flooding emerging markets as Trump's tariffs force manufacturers to find other countries to export to. That's led to a ripple effect for some markets in Asia. Take Indonesia, for example. It's lost roughly 250,000 jobs in the textiles industry over the last 2 years. Bloomberg's Asia economics correspondent Katia Dmitrieva is joined, Katia, I should say, Dmitrieva is with us now. Katia, what are we calling the new China shock, and where are we seeing it take place?
Yes, it's really China Shock 2.0 or 3.0, which is, as Gordon Hanson put it, he's one of the trio of economists who first coined the term back in the 90s and early 2000s. And before, we're really used to describing the China shock as something more specific to the U.S., describing the economic damage and job loss from this flood of Chinese imports, kind of back when China first joined the global trading system and the WTO. But today, we're seeing it much more broadly across the world. We're seeing it in Mexico, in Brazil, in places like Indonesia, like you just mentioned, and across Southeast Asia. So basically emerging market economies, which really rely on their manufacturing sectors for growth, both domestically and trying to export those goods for their economic growth, are facing a lot more competition from China. And the reason behind that, you may ask, is Trump's tariffs, President Trump's tariffs, as well as the reciprocal tariffs that are set to come in. So once China realized they could no longer export to the U.S. as easily, there was this big reshuffling of supply chains, and there was also a big gap in where they had to send their goods to. And so that's why we're seeing a lot more of those goods flowing to other countries.
Yeah, what are the governments of those other countries doing to address this? Because I'm aware of some responses from quite extreme all the way through to nothing at all.
Yeah, it's tough, right? These countries are basically in between a rock and a hard place because they have industries and workers telling them and pushing on them to do something about this because there has been wide-scale job loss, factories are closing down, factories are moving elsewhere, which is very similar to what we saw in the U.S. Rust Belt as well in the 90s and early 2000s. But they're kind of stuck because China is a major trading partner, a major purchaser of these countries' goods as well, and also a major source of foreign direct investment. So moves so far have included VAT, value-added taxes, small tariffs on steel or small packages, but they're really limited in what they can do.
China has been for a while trying to shift the focus from being just a manufacturing powerhouse to boosting domestic demand, and that's really taken top priority. Does that potentially change the strategy at all?
Yeah, it really depends if it works, right? This is something we've been hearing from China for a while. They've really underscored it in 2025. They said we're going to unveil all these programs, child subsidies, boosting pay in domestic, like in regional markets, in a normal way, at a normal pace. But it really depends if those things pan out, because the reality is that China has a close to $1 trillion trade deficit with the world. That means that it's just heavily exporting these goods still, and that's where the growth is coming from, is the reality. So if these consumer-focused programs work out, perhaps they could shift some growth that way, but so far that's not been the case for them.
All right, Bloomberg's Asia economics correspondent Katia Dmitrieva there. Now you can read more about the new China shock in today's Big Take. That's on the terminal, or you can find it at Bloomberg.com. The Philippine Central Bank governor says he's not worried about a potential influx of Chinese goods as the tariff war reshapes global trade and supply chains. Eli Remolona spoke exclusively with Bloomberg's Linda Amin in Manila.
Oh, when China does well, everybody in Asia does well. We trade with China. We import most of our. China is our biggest source of imports, and we also export to China. So China's growth is good for us.
Mm-hmm. Are you convinced with its recovery story?
We'll have to see. I think.
What are you looking out for?
More sustained recovery. We're hoping they get a handle on the property price bubble.
So the property sector is still what's key for you?
Yes. I think that's still the main risk.
In my conversation with several central bank governors in the region,
yes,
they've expressed concern about China dumping cheap products on the back of the tariffs that were imposed by the U.S. on Chinese products. How are you assessing the risk of that happening in the Philippines?
We don't see that happening to us. Because we're already importing from them. So it doesn't really make sense.
What do you see China doing in the coming months, perhaps, to boost its economy further?
Oh, yes. They've been making a big effort in that direction, and I think it will have an effect. It will work to some extent.
Philippine Central Bank Governor Eli Remolona there speaking with Bloomberg's Linda Amin. Take a look at how we're tracking when it comes to moves on the FX side of things as Asia continues to react to what was ultimately a pretty sort of calming effect from Fed Chair Powell in his comments overnight, particularly when it comes to some of the nervousness that we've seen over the tariff implications, inflation implications. Dollar yen, a little bit of softness there, 148.47 is what we're watching. And dollar China also seeing a little bit of a move as well. But really, we are seeing the greenback kind of pairing most of its advance on the back of the comments on potential for slower growth trajectory going forward, keeping rates unchanged, of course, from the Fed. The yen remaining that sort of best performer in that group, but we're starting to see a bit of a rebound there in the euro as well. More ahead on the Asia trade. This is Bloomberg.
Despite US tensions casting a shadow over Chinese tech advances, AI startup Manycore Tech says it's looking to grow its global presence. Manycore is known as one of the country's 6 little dragons, companies that have transformed Hangzhou into an innovation hub. Co-founder Victor Huang told us exclusively how the designation has changed the conversation with customers and investors.
We are very happy to be one of the 6 dragons. But I believe there will be more and more high-tech companies to be famous like us. It's also make us easier to get in touch with a potential customer. And before many people in the embodied AI industry, they are not know who you are and what is Manycore Tech. But now it's make us much easier to introduce ourselves. They are going to just more willing to try our solution.
How many more people are also now approaching Manycore to work for the business?
Before, it's very hard to hire the talents just from top university. Right now, I think it's totally changed. Just the people from all over the world and from all the China, the top talent, they are going to get in touch with us. They are send a resume to us, want to join us. And during these 2 months, many top talent from like Tsinghua University, Zhejiang University, Beijing University, even from Stanford, Harvard, they are send resume to us. Then some of them already join us. I'm really just feel really amazing about the current situation.
I want to ask about your customer partnerships, because one of those for Spatialverse is with Agibot, which is a relatively well-known robotics startup from China as well. How does it work in practice exactly?
If you are going to training robot in physical world, it's really hard. Normally, you need more than 10,000 scenes for a robot to training one small action, or we call it small AI model. But 10,000 physical room or physical space is really hard for AI training in real world. Can you imagine you need to find 10,000 space in Hong Kong? I think it's mission impossible. But in real world, you can not only have 10,000, you can have 100,000 or a million. It's easy. I make an example. Just in the physical world, if you want to make a space, you probably need to spend like at least 100,000 Chinese yuan in China. In Hong Kong, it's probably need 1 million. But in virtual world, like for our system, it's probably less than 1,000. So it's much cheaper and faster.
Talk to us about also, you have plans to expand more globally. So what exactly does that look like for Manycore?
We have the users from more than 200 countries and regions. We have a local team America, Korea, Thailand, Indonesia, Malaysia, just more than 10 countries. We have local team to serve them. So the globalization are different, but our global business is also growing very fast, especially for the freemium model.
Manycore Tech Chairman Victor Huang there speaking with Bloomberg's Annabelle Drewlers. Let's get you caught up with some of the corporate headlines that we're following this hour. And the EU has issued twin rebukes to Google and Apple to comply with its big tech rules or risk hefty fines. Google was warned for allegedly breaching the bloc's Digital Markets Act by favouring in-house services and its own Play Store. Meanwhile, Apple was told to loosen controls over its iPhone operating system. Any future EU penalties could escalate tensions with President Trump. Bloomberg has learned that Elon Musk's social network X has raised close to $1 billion in a new equity from investors, valuing the company at roughly $32 billion. Sources say Musk himself participated in the equity raise, and the company is said to be considering using some of the proceeds to pay down its remaining debt load. Ben & Jerry's is accusing its parent company Unilever of firing CEO David Stever because of disputes about the brand's social stance. In a legal complaint filed in New York, the ice cream giant alleges Stever was dismissed after he failed to stop the brand from speaking out on political issues. The dispute is part of a larger clash over how Ben & Jerry's communicates its social mission. Aman Group, which builds and operates some of the world's most expensive hotels, is planning to raise up to $2 billion to fuel its global expansion plans. The company says the funding will help it make headway on 23 hotel projects currently under development. The firm is also focusing on expanding Aman residences around the world. More ahead here on the Asia Trade. This is Bloomberg.
Think if you're in corporate America and you hear that, what do? You stop spending and you hold all the capital you can. This is a very dovish Fed.
I think this was much more hawkish, and the Fed not quite going to one rate cut, but the number of people who are expecting one rate or less cut this year going up. That gives you that sense of the dispersion of risk and the challenge of corralling the cats in a very uncertain environment.
There's kind of clear elements of both of these here. I think the market's view is it's not as hawkish as was anticipated. I think there was a fear of a median of one rate cut for today, and so far at least that fear was alleviated.
The market is rallying today because this was not as hawkish as it could have been. I think the risk coming into this was maybe we just saw one cut in 2025. We kept the two, but going forward, I think we should be baking in some widening credit spreads, and we would view that as an opportunity.
Business leaders and economists talking to Bloomberg about the Fed's decision to hold rates while forecasting slower growth and higher inflation. Let's take a look at how currencies reacted. We did see a little bit of weakness for the US dollar off the back of that decision. So the yen now at 148.43. Bloomberg Intelligence is out with a note saying slower US growth could hurt demand for Asian exports, and that could see the dollar strengthen in the longer term. But for now, we've got a little bit of dollar softness creeping in there. The Aussie dollar, though, has slipped quite a bit, off about 1/3%. This is after jobs numbers for the month of February missed. The headline rate held steady, but the number of jobs created did in fact contract in the month of February. So a little bit of softness for the Aussie there. We do have a Reserve Bank of Australia decision coming up on the 1st of April. The cash rate currently at 4.1%. There was not expected to be any change to that, but this weak jobs numbers does add an interesting new point of conversation there. The euro, meanwhile, showing a little bit of strength, 109.10 at the moment. Let's see what's going on in commodities as well. Right now, we've got iron ore just slipping below $100 per tonne. So they have been holding on above that by its fingernails. That notwithstanding, we do have most sectors on the ASX higher, including material stocks. The oil price as well pushing higher. We've seen US gasoline stockpiles hit their lowest since January. A bit of movement on the geopolitical front as well, with the Ukrainian President Zelenskiy agreeing to a mutual halt on strikes on Russian and Ukrainian energy assets. In the meantime, though, Israeli troops have now occupied a corridor bisecting Gaza, so tension in the Middle East continues to rise. We're seeing a modest tick up in the oil price, Haidi.
Yeah, take a look at what we're watching when it comes to cryptocurrencies at the moment. Of course, it is a bit of a rebound day when it comes to the likes of Bitcoin, not so much for Ether. But broadly, we have seen really that shedding of US Bitcoin ETFs to the tune of $5.5 billion, a longest run of outflows since listing in January this last year, I should say. A lot of the tariff concerns and broader macroeconomic concerns driving a wider retreat from riskier assets. Perhaps some of the sort of calm being restored by Fed Chair Powell's comments overnight, despite the amount of volatility that remain, might be also driving a little bit of an update for cryptocurrencies as well at the moment. Ripple's CEO Brad Garlinghouse says US Securities and Exchange Commission's landmark case against it has ended. He told us that the move is good for the company and for the wider crypto industry.
The SEC has abandoned their appeal, and so they filed suit in December of 2020. We won on the key parts of the case in the summer of 23. Judge Torres made a ruling that XRP in and of itself was not a security. That's almost a verbatim quote. The SEC filed an appeal about 8 months ago, and what they've now agreed is that they're going to drop that appeal. We still have a cross appeal pending, and so we go from being defendant really to plaintiff. So we now are in the driver's seat to determine how we want to proceed.
Are you dropping it?
We're going to see. It feels a lot better to be on the offense than the defense. 4 years, we spent over $150 million defending that case, not just for Ripple, but for the whole industry. I think it was really important that this SEC, the Gensler SEC, was really trying to bully and continue lawfare, filing lawsuits and lawsuits and lawsuits against crypto companies. That's over now, and I think that's great for the U.S. crypto industry and, frankly, great for crypto at large.
I mean, to that end, if you're looking at a new SEC, why not drop the case at this point? Why not clear the why not clear the water?
Well, that certainly is an option. I mean, again, it's clear the SEC has said, they, I think in retrospect, never would have brought this case. The judge did rule in certain instances back in 2015 and 2016, some XRP sales that we sold to accredited investors, to institutions, that those had constituted a security. And so there was a $125 million fine that's sitting in escrow. We wouldn't mind having that back. That's on the table, and I think there's some nuances to how this will play out. But it was important for us, for really the whole XRP community, for them to know that the case is over. For all intents and purposes, the case is over. The SEC is no longer pursuing this.
But to that end, to your point here, the court decision had ordered you to pay a $125 million civil penalty for exactly what you're talking about. Is that $125 million paid? Is what you're saying that's still up for dispute?
Yeah. Well, it's not in dispute. I mean, that's sitting in an escrow, and depending upon whether or not we decide to continue with our appeal, we could walk away and the whole thing would be done. On the other hand, when you have a case where there were no investor harm, no investors lost any money, you're kind of like, wait, like, why are we here? And it really goes back to Gary Gensler fighting a fight that was about power grab, that was about overreach of the bureaucracy to try to take a new industry.
That's Ripple CEO Brad Garlinghouse speaking there with Bloomberg's Sonali Basak. Let's take a look at how markets in Asia are tracking at the moment, mostly to the upside, in fact entirely to the upside. We do have Japan closed today for a public holiday, but here in Australia, better by 0.8% at the moment. Pretty much every sector higher, the heavyweight financial sector performing at best of all. And markets perhaps propelled higher by that weak jobs read for the month of February we just had out of Australia. That was a bit of a miss. The RBA is not expected to ease at its next meeting, which starts at the end of March. However, that jobs number does at least provide an interesting topic of conversation. The Kospi, meanwhile, better by 0.4%, and New Zealand better by similar. And we did have New Zealand exiting recession earlier today, posting growth for the fourth quarter of 0.7%. The Finance Minister, Nicola Willis, saying, well, this is a good sign. Still a long way to go, but promising that there are better days ahead for Kiwis. Heidi.
Yeah, Paul, take a look at what we're setting up when it comes to the China session. Of course, we're in the thick of tech earnings, and some of those will be very positive drivers, the likes of Tencent, right, and how we see that across the rest of the sector, watching the impact when it comes to Pinduoduo there as well. But we have had some sort of managing of expectations in terms of how far this rally in China continues to run. BFA strategists looking at some risks, saying that the rally could face a meaningful correction soon. Both the Hang Seng China Enterprises Index, MSCI China Index up at least 30% from mid-January, and that correlation with what happened in 2015 could see a correction soon.